You're listening to Let's Talk Macro.
Brought to you by Bandhan Mutual Fund.
Hello, everybody. How are you doing? You're catching me, Ahalya, on a brand new edition of Let's Talk Macro, a podcast on macroeconomics by Bandhan Mutual Fund, where we actually bring you interesting, important, and very topical, relevant macroeconomic themes and conversations, both global and domestic. And all of this includes, relevant economic events, data, concepts, and many of the inferences that we can draw, as well as the implications that we can observe happening from these phenomena. Joining me in conversation today is Sreejith Balasubramanian, economist in the Fixed Income Fund Management team. Hi, Sreejith. How are you doing?
I'm good, thank you. How are you, Alia?
Doing very well and very glad to be in conversation with you once again, Sreejith. So today we're going to be talking about the recent financial market turmoil that has been observed in the US and Europe, as well as the recent monetary policy decisions by the US Fed and the European Central Bank, which is the ECB in this context. We're also going to see exactly, what drove these market events and how it poses a policy dilemma for, these central banks specifically, as well as the rationale behind the decisions by their monetary policy committees earlier this month, amongst all of the uncertainty, because there's a whole lot of that. So a lot to unpack, Sreejith. Why don't we first start with the market reaction? Sure. It all started with the Silicon Valley Bank, which is the SVB, issuing in the US a few weeks back. Can you talk to us a little bit about what really happened in the US banking sector and how you see the intervention so far by the central bank or the government?
Sure. So it's really been an eventful 3 weeks so far. So like you said, it all started with SVB. It actually sold some of the US Treasury bonds it was holding to fund the deposit outflows which happened. And it realized losses at rates, as rates had actually moved up quite a bit in the last year or so. So therefore, it was actually an asset liability and interest rate management issue on top of the fact that actually it had a very concentrated business model and had grown its assets very fast in the last 2 to 3 years. But the big question then was what the treasury bond losses could be for other banks and how safe bank deposits are, especially the portion which is beyond the insured limit. So this particularly put pressure on the smaller and regional US banks as they experienced some very strong deposit outflows, mainly to money market funds. And in fact, the regulation of some of the smaller US banks was also eased in, back in 2018. So all said, the Fed responded immediately by introducing a new bank term funding program, apart from its standing discount window, that is. And this was to actually provide liquidity to banks and even other eligible depository institutions to help meet their demand for deposits. So through this program, the Fed essentially offers loans of up to 1 year against collateral such as US Treasuries. And the important point note here really is that this collateral was, or rather is valued at par. For the loan, that is, and it will actually not consider the notional losses that banks could be sitting. And as a backstop, the Treasury also provided $25 billion towards this facility, in case there are losses, but this is not really anticipated. And the second thing is that the Fed, along with the Treasury and the Federal Deposit Insurance Corporation, the FDIC, made a joint statement that the FDIC has been enabled to complete the resolution of the Silicon Valley Bank. Says that all depositors have, full access to their money and no losses are borne by the taxpayer. They also, in fact, announced a similar exception for another bank and also announced a review of the, SVB supervision and regulation.
Okay.
After all this actually happened, some of the bigger US banks came together and pumped in like $30 billion to support a smaller bank. And in fact, I think very recently SVB has got acquired by another bank also. And even in Europe, if you see, we obviously saw a big bank get acquired very swiftly there. So the response has really been fast by the central banks and the government together to sort of ring fence the issues, if you want to call it that, as they emerge.
Ring fence the issues. Okay. I think I understand what you're saying. So if you could also just shine a light on the situation currently in the US and, more importantly, the US is a huge player in the global economy. So how have markets reacted so far to all of this all over the world?
Sure. So if you actually, the one way of looking at it would be through the Fed's balance sheet. So if you actually look at the Fed's balance sheet for the week after the SVB issue surfaced, Fed's lending facilities went up by almost $300 billion. And for the week after that, this was only up $17 billion. And this is mainly only in 1 or 2 regions. So that's a liquidity window usage by banks actually stabilizing a bit. On market reaction, most notably, US Treasury yields have fallen quite a bit. So, for example, if you take the 2-year US Treasury bond yield, which is also reflective of policy rate expectations, has fallen from around 5% before all this to the 370 to 390 range recently. So the market has completely changed its rate hike expectations, and now it sees aggressive rate cuts by the Fed this year itself to tackle the turmoil, as financial conditions have suddenly tightened and high yield bond spreads have widened. So even in Europe, markets rate hike expectations, if you see, have come off. And all this feeds into emerging market rate expectations also eventually. So quite a bit has happened, and it's only been like 3 weeks. So the uncertainty is still very much there.
Yeah, and I think, as we know, the US Fed fighting off very high inflation for quite some time. And, you even shined a light upon previous episodes. Also, before I ask you about the central bank's dilemma, I think this is a good place to start. How is inflation right now in the US and the European region? Because we've also been reading that goods inflation is coming off. So are things getting better? Are things still really uncertain?
Yeah, so high inflation and the quest for price stability more specifically has been the driver of the Fed and the ECB's policy choice to hike interest rates significantly from last year. So it's true that, like you said, goods inflation has been coming off as supply chain bottlenecks unclog, commodity prices have been coming off even for energy goods, and demand growth has also softened a bit. Policy rate hikes have also been working through the economy, particularly the interest rate sensitive sectors like housing, for example. So on the other hand, if you take core inflation, which is the headline inflation excluding the volatile food and fuel components, core inflation has actually fallen less, and it continues to remain uncomfortably high. That is. So now this is also because services inflation has been staying high. In the US, for instance, momentum in used car prices has been falling quite well. But if you see housing rent and non-housing core services, which is what the Fed looks at closely, as it tracks wage growth, that continues to remain high. So it's been staying high for quite some time. Even in the euro area, core inflation has been high and sticky, despite energy prices falling more than what was expected some time back. So that's the kind of inflation that we have in US and Europe right now.
Okay, and then that brings me to the question on the central bank's policy choice, their dilemma that they're probably dealing with right now. So the Fed and the ECB have been raising interest rates to fight inflation, which, as you already mentioned, is uncomfortably high, right? But at the same time, the recent banking sector issues occurred, and there's this fear of financial instability and global contagion and so on. So how can they continue to focus only on their fight against inflation rather than also all of this collateral damage, I guess, coming through?
Yeah. So this is probably the most important question, what markets are continuing to ask. Let's look at it for the US first. Like we discussed, inflation continues to be high, but even other economic data like non-farm payroll additions, retail sales, services PMIs had all come in stronger for January. Now, this raised expectations for a stronger rate response from the Fed, and the governor in his testimony to the Congress, which happened just a few days before the SVB issue, said peak rates could actually be higher than previously expected, and the pace of hikes also could be higher if needed. This had raised the expectations of a 50 basis points hike instead of a 25 basis points hike. But then now market rate hike expectations have completely changed, and they are pricing in rate cuts, like I said, by the Fed this year itself. But that's it. Going into the meeting last week, it was still expecting a 25 basis points hike this month, which is what the Fed did, again at the meeting last week. So the interesting part there actually lies in the details. So one is, if you look at the FOMC statement, which previously mentioned that it anticipates ongoing rate increases to return inflation to 2%, was actually changed to read some additional policy firming may be appropriate. Second, the latest summary of economic projections, which is released quarterly, was previously expected to show an increase in the median peak policy rates for 2023. But this was left unchanged. Three, I think the governor during his press conference said the recent events are likely to tighten credit and economic conditions, meaning it could work in the same direction as rate tightening, but that it's too soon to say what its effects could be and therefore how monetary policy should respond. So essentially what he said was like, look, these events in the banking sector just happened a few weeks back. We have taken some measures and have more tools if required. The issues could impact the economy the same way as rate hikes do. And if that is the case, policy tightening warranted would be lesser. But it is too early now to decisively take a view. So although the market expects rate cuts this year, which is not the Fed's base case, The policy meeting and hike last week was viewed as dovish.
Okay.
But again, what lies ahead will depend on these issues and also on how strong inflation and other economic data turn out to be. For the ECB, on the other hand, the story is actually broadly similar.
Okay.
But if you remember, the ECB started hiking policy rates from July last year, which is 4 months after the Fed started. And it had to start hiking rates from negative, unlike the Fed. So it has so far hiked rates by like 350 basis points, while the Fed has already hiked 475 basis points. And in the February meeting of the ECB, it said, it actually sounded quite hawkish. It cited inflationary pressures, hiked by 50 basis points. And in fact, it also said it intends to hike by another 50 basis points in March. This is again what it did in this month's meeting. And it continued to cite underlying inflationary pressures. Okay. But here again, like we discussed with the Fed, there are a few things actually to note on the details. Even in the statement here, they dropped the line which said it'll stay the course in raising rates significantly at a steady pace. So this line was dropped, and it added that the elevated level of uncertainty demands a data-dependent approach. And by that, what they actually meant is, it'll include an assessment of inflation based on incoming economic and financial data. And financial data here mainly referring to that of credit and financial conditions in light of the recent events. Similar change in language, so if you see, to that of the Fed. But it is not as explicit in acknowledging the potential impact of recent events. It did mention that the European banking sector is resilient and there is no trade-off as such between price stability and financial stability. As a rate hike is where price stability and liquidity facilities available are to address any market tensions and thus financial stability concerns. So overall, less dovish, one could argue, maybe compared to the Fed. But here again, apart from how the issues evolve, inflation data, wage pressures, and profit margins, are some of the important factors that they take into consideration. So again, all said, it's too soon for both the central banks, both Fed and the ECB, to sort of drastically change the interest rate policy. And this is actually what the recent meetings reflected as well. So if they had suddenly paused, for instance, or hypothetically, it could have also, posed a question on their credibility. So for now, if you see, the Fed has deployed its liquidity facilities while the ECB stands ready. The Fed has more explicitly acknowledged the impact recent events could have on financial and economic conditions, and thus future monetary policy actions. But it just cited the uncertainty for now. So price stability will continue to be important for both central banks, definitely. But so will financial stability if the recent turmoil sort of snowballs. So we'll have to first see how these two factors develop and how big a trade-off they actually turn out to be.
Wow. Okay. Well, there's a lot of things at play here. And I guess our end point on today's podcast is that it hasn't been easy at all for central banks in the last 3 weeks. And even for the markets, it's been a bit of a rough time because on one hand, we've got inflation and other economic data has also been strong. And then on the other hand, we have financial turmoil, which, was a result of the US banking sector 3 weeks ago. But, Europe is also feeling the heat as a result of that. So this basically just means that they can no longer afford to solely focus on inflation and, also might have to create a trade-off and dilemma, about their policy choice. But I guess uncertainty is still very much there. So it's just going to rely on the next couple of weeks or months to see how it all plays out, right?
Yeah.
Perfect. Well, thank you so much, Sreejith, for joining us on this edition of Let's Talk Macro. And I hope all of you listening, got a slice of this pie today in the context of the monetary policy in the US and Europe area currently, given the recent events in financial markets. That's all for now. We will be back with another episode of the podcast series. Thank you once again, Sreejith, and thanks everyone for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.